Should you pay off your mortgage? You've probably heard the advice 1,000 times. Pay off your mortgage before you retire. Get the debt off your books. You'll sleep better knowing that your own home is free and clear. Sounds reasonable. And it feels like the right move a lot of the times. But what if paying your mortgage off before retirement left you in a worse condition financially? What if the math tells you a completely different story than the one that you've been sold by most people? Today, I want to show you why this decision is a lot more complicated than most people realize, and why the choice that feels right could potentially cost you real money. Hey, it's Jason Solomon with Tactical Investment Advisors. Your mortgage rate matters. Millions of homeowners who bought or refinanced during the low rate years are still carrying mortgages in the 3 or 4% range. That's a substantial difference from a 6 or 7% mortgage. Let me walk you through it with some numbers. Say you've got $200,000 left on your 4% mortgage, 20 years remaining, and another $200,000 sitting in investments. The move most people make and are told to make is just pay off the house. Your debt's gone, you got peace of mind achieved, but let's compare the trade-off. If you carried that mortgage for the full 20 years, you'd pay roughly $91,000 in interest. Pay it off today and you avoid that future interest expense. That sounds amazing. But here's the other side. If that same $200,000 remained invested for 20 years and hypothetically it averaged 6% annually, which by the way you can do without going into the stock market, it could grow to roughly $640,000 before taxes and fees. That doesn't mean keeping the mortgage automatically wins. That 6% return is not guaranteed. Markets don't move in a straight line. Taxes, investment fees, all these things you've got to be mindful of when you're considering a situation like this. And obviously, paying off the mortgage gives you something that the investment portfolio can't, and that's a guaranteed reduction in future interest expense. So the real comparison isn't as simple as 4% versus 6%. You've got to look at risk, taxes, liquidity, cash flow, and where the money you're using to pay off the mortgage is actually coming from. This last part could be huge. So if $200,000 you're considering using to pay off the house is sitting inside a traditional IRA or a 401k, you're going to have to recognize a taxable income from that distribution that you use to pay the house off. And a large withdrawal could potentially push some of your income into higher tax brackets, increase your Medicare premiums, and just create all these unintended tax consequences. On the other hand, some homeowners who itemize may be able to deduct qualifying mortgage interest, and that can affect the effective cost of carrying that loan. You see why you can't just make this decision based on comparing 4% versus 6%? Let's talk about another risk that almost nobody thinks about, and that's liquidity. Pour $200,000 into your house and your net worth hasn't disappeared, but the money isn't nearly as accessible anymore. You can't use home equity to pay an unexpected expense as easily as you can use cash or liquid investments. If you need that money back 5 years later, you may have to sell the home or borrow against it, potentially at much higher interest rates than the mortgage you originally paid off, which we know is the case right now. If you're locked in at 3.2%, go try to refinance right now or go try to get a home equity line. It's not going to be anywhere near that. You're going to be looking at 6.5, 7, 7.25%, all because you needed access to some liquidity. Those are the kinds of trade-offs that are worth thinking through before you write a check. There's another side to this. Paying off the mortgage can create something incredibly valuable in retirement: lower monthly expenses. If eliminating your mortgage means you need several $1,000s less from your portfolio every month, that can reduce the amount your investments need to produce each year. For someone entering retirement with a tight withdrawal rate, reducing that fixed monthly obligation can be very valuable. I'm not telling everyone to hang on to their mortgage forever. There are absolutely situations where paying it off makes sense. The higher your mortgage rate, the more attractive paying it off can become, because the guaranteed interest savings become harder for the investment portfolio to beat after accounting for the risk, taxes, and fees. If you've already got substantial liquid assets and paying off the mortgage isn't going to leave you cash poor, getting rid of the debt may be perfectly reasonable. Carrying a mortgage causes you enough stress that you're constantly making other bad financial decisions because of it. There's value in eliminating that burden too, but you're still going to have to deal with your month-to-month expenses. If the alternative is keeping the money in relatively low return investments, paying down the mortgage may become more attractive because the expected return you're giving up could be relatively small. This isn't just a spreadsheet decision, it's a retirement plan decision. And here's what really gets me. A lot of retirees never run this comparison at all. They pay off the mortgage because it feels responsible, or they pay off the mortgage because their friends did it, their parents did it, because somebody told them that you're not supposed to carry debt into retirement. But something being conventional doesn't automatically make it right for your situation. If you're watching this and you're realizing you might be about to make this exact decision, or you've already made it and you're wondering whether it was the right move, you're far from alone. It's exactly why we help clients run the real numbers on the decisions like this. If you'd like to see what makes sense for your specific mortgage rate, portfolio, tax situation, and retirement timeline, there's a link in the description below to book a time with us. So here's what to do before you pay off the house. There's 3 things. First, you have to know your numbers. What's your mortgage rate? How many years are left? Where would the payoff money come from? Will any taxes be triggered by using that money? What return are you realistically giving up by taking that money out of your portfolio? Don't just compare your mortgage rate to some assumed market return. Compare the entire financial impact. Second, stress test your liquidity. If you put a large chunk of your liquid assets into the house, how much money do you have left that's easily accessible? Can you absorb a major unexpected expense without having to borrow against the house or sell investments at a bad time? Because being debt-free but cash poor can create a completely different kind of risk. Third, separate the math from the emotion. Ask yourself honestly, am I doing this because of the numbers support it? Because eliminating the payment improves my retirement cash flow, or because being mortgage-free simply makes me feel better? And by the way, that last answer isn't wrong. Peace of mind has value. You just want to understand what you're potentially giving up to get it. Paying off your mortgage before retirement isn't automatically the smart move. And keeping the mortgage isn't automatically the smart move either. For some retirees, carrying low-rate mortgages, keeping more money invested, and maintaining liquidity may produce a better long-term outcome. For others, eliminating the mortgage can reduce expenses, lower the amount they need from their portfolio, and give them greater financial flexibility in retirement. The right answer depends on your mortgage rate, taxes, portfolio, liquidity, your risk tolerance, and what matters most to you. Don't make the mistake of deciding based on instinct alone. Run the numbers before you write the check. And if you want help doing that, book a time with our team. The link is in the description below. If you'd rather start on your own, you can download my free retirement guide using the link below as well. We'll see you in the next video and hopefully on our calendar.